One of the things that I often talk about in these podcasts is to follow the money. And the money can only go into four major asset classes on this planet. Money can either flow into currencies, which for most people, they say, I don't do currencies. But if you own cash, if you live in the US and have money in US dollars in your savings or checking account, you are in the currency business. So one of those four major asset classes is currencies. Another one is debt. That's bonds, whether it's corporate bonds, government bonds, municipal bonds. It's bonds, also known as debt. Another one of those four is equities or companies. Now, mostly we talk about publicly traded companies in here, but it could also be in private companies. But that is one of the four areas money can flow is in companies. And the fourth area, not necessarily the last, is physical things. That could be houses, corn, oil, gold, silver, things that are physical in nature that if you drop them on your foot, it would hurt. So those are the four major assets that money can flow into, and then within them, it breaks down. So the question I'm always asking myself, or often asking myself, is where is the money flowing? Where is it flowing out of, and where is it flowing into? And when you take that big picture kind of theme, it can tell you a lot about how people are feeling. And so with this weekend's podcast, I want to talk a little bit about where money is flowing and what that's telling us about the overall psychology of the market today. Hey everybody, this is RC Peck, and this is my weekend podcast. And the theme for this weekend is the biggest movers of 2015. Now, even though 2015 is only, 10 days old, we're seeing some pretty big moves so far, and there's two particular and specific major assets or major players on this planet that there are some big moves happening, and it's telling us a lot about what's going on in the world. So I want to look at those two price charts and tell you what I see happening. The first price chart is U.S. government bonds, specifically U.S. long-term government bonds over a 20-year duration, but no more than 30 years. Now, what you see on the screen is the yield of that 30-year U.S. government bond. And the thing I want to point out the most to you is that horizontal red line that I just put in. And notice that at the end of 2008, the yield of the 30-year touched it at about 2.5%. Then in 2012, it touched it again, and now today it's touching it again. So 3 times the yield on the 30-year Treasury, U.S. Treasury, has hit this 2.5%. And at least 2 of those times it has moved very quickly off it, almost like a springboard to go higher. Now, I don't know if it's going to springboard higher this time, but there's certainly precedents over the last 6 or 7 years that once the 30-year hits 2.5%, there is a move up in the yield. Now, I don't know if that's going to happen, but what I do want to point out is when the yield is going down on the 30-year Treasury, people put money in the 30-year bond because they're concerned about the future. And they think this is a place where they will get their capital back. They will get their money back. And yeah, they may only get 2 or 3 percentage points a year, but they are going to get their money back. So when people are concerned, like they were in 2008 with the 2008 meltdown, or in 2011 when the U.S. could not figure out how to raise their debt ceiling, the market fell really hard, and people moved a lot of money into bonds. Or right now, in 2014, where the sense I'm getting is people are really feeling like there's a lot of uncertainty going on in the world. And you know what? I'm going to put my money in long-term bonds, and specifically I'm going to put them in long-term bonds from the U.S. government because over the last 230 years, that seems to have been a place that has been very safe to put my money. Now, will we bounce off of here? I don't know, but for sure, we know that the world of the world's thinking or behavior is one of being more concerned about the future and not less concerned. And that's something we should make note of. The other thing too is, 30-year bonds in Europe, 30-year bonds in Japan are yielding much less. And the currency of those two blocks, I know Generally speaking, the currency in Europe is the euro, though there are some other small currencies, but let's just say it's the euro. The euro and the yen are absolutely getting crushed. Those two central bankers want their currencies to be much cheaper to help out their countries which are in deflation. So money's flowing into U.S. government bonds. That's driving the yield down, which means people are more concerned. The second price chart I'm going to show you is of oil. Now, this particular price chart goes way back to 1983. So we're really getting a lot of data here, 2 decades of data. And I want you to notice that oil has broken below that diagonal trend line starting in 1999 and trending up, hitting it in 2008. And of course, oil crashed right through $70. But what's most important is there seems to be this support. There's this old resistance that oil cannot get above $40. Couldn't get above $40 in 1991. Couldn't get above $40 in 2003. It was a point of really pushing the money back. People were not willing to push oil higher than $40 a barrel, basically before 2004. And then once it did break above that price in 2004, that became a support for it. Even in 2008, it fell actually to about $33, which is close enough to 40. But now the question is the 40 going to hold? So what it looks like from a historic point of view is that the next major resistance for oil is going to be at the 40. And I'll actually give a range between $35 and $40. That's where it looks like oil is going to want to go. Now, how long does it stay there? Does it only stay there a couple days, couple weeks, couple months, and then move higher and find more of its, neutral stance? Maybe oil really should be about $70 and it's overcorrecting down to $35. But right now, people are moving out of oil. And so the question is, why is it happening? Is it because the demand for oil is falling, which means the world economy is getting worse, which means deflation? Or does it mean there's so many more oil producing wells in the United States and around the world that the increase of demand has been minimal, but the increase of supply has been a lot? And so now what we're just noticing is there's a lot more supply, but just a little bit more demand, which is going to push the price down. The answer is we don't really know yet. It could be either one of those. It could be that there's way much more supply and not enough demand. Or the scary part is that maybe things aren't going that well. And maybe the companies that need energy don't need it anymore, so they're not buying it. And that would be kind of a world economy thing. But we're going to watch it. For what we know for sure is money is flowing out of oil. That is deflationary. That gives cover to Mario Draghi, and Shinzo Abe in Japan and Janet Yellen to be very loose with what they do with their monetary policy, which is going to be a benefit for stocks. So the more the yield goes down, the more people are concerned. And I'll be continuing to watch that. The takeaway is we got to follow the money. The way you can follow the money is through price charts. Price charts don't lie. They tell us where money is flowing into. They tell us where money is flowing out of. And right now, money is absolutely flowing into long-term U.S. bonds, has been for over a year, and it's continuing and it's accelerating. And we're going to watch that. And as money flows in, that means people have more concern about the future. And the other thing that we're really noticing is people are taking money out of oil. So for sure, money is moving out of oil and into, for sure, U.S. dollars and U.S. bonds. Hey guys, this is just another step in helping you secure your portfolio and your future. Until next time, I'm R.C. Peck.